Let's stay with banking, and here's another big exclusive. HDFC Bank is looking to make securitization a new avenue to raise resources. The bank sees many of its parameters like loan growth and loan deposit ratios returning to pre-merger levels by 2027. The bank is garnering increased synergies from the merger, with 95% of new home loan customers opening an HDFC Bank account. My colleague Latha caught up with the CEO, Sashi Jagdishan, and CFO Srini Vaidyanathan, and she's with us with the key takeaways. Latha, good morning.
Good morning. Not often do the biggies of HDFC Bank speak. So it was a long chat, not intended to change the margin and those kinds of guidance, which is already in the public domain, but more in terms of strategy. Now, one of the big things that has shaken the market is this big securitization, some 13,000 crore of auto loans that HDFC Bank has put on sale. And the idea seems to be, according to Shashi, that it's a new way of garnering resources. There are a lot of foreign funds out there which are wanting to buy good Indian credit because, you get higher yields over here. And so this year it may be just 15,000 crore, but in course of time, this can be a 1 trillion rupee generator of resources. But more importantly, it is this loan deposit ratio, which Reserve Bank has been telling all the banks to, grow their deposits first before they grow their credit. So the credit deposit ratio of HDFC Bank had gotten very skewed because of the merger. The point that Srini Vaidyanathan was making is that their pre-merger comfort zone was 85 to 90% was the loan deposit ratio. That is 100 rupees deposits, you should have 85 to 90 credit. Now they are a little over 100. So they expect to come down by 2027 to the pre-merger comfort zone. Originally, they had said 4 or 5 years. So this is a remarkable difference that by 2027, they will come to the old loan deposit ratio. It's also, he reiterated, Srini, what he had said in the conference call. Their loan growth this year will be lower than industry. Next year, in line with industry. And FY27, that is, it will be higher than industry, which it always used to be in the pre-merger days. Then the other big talking point, of course, was bancassurance, Yash story, and the fact that, banca should not be the big source of new policies for the insurance company. He said in HDFC itself, Sashi Jagdishan said, we have always encouraged open architecture. When we sell products to our banking customers, we sell whichever is good. Any insurance company, any mutual fund has been our way of doing things. Also, we have got very thorough recordings when our bankers sell insurance products so that we are very sure that the customer is not coerced. That said, he felt that although none of the regulators have spoken to them, if this comes, restricting bancassurance, then the spread of insurance or insurance penetration itself can get affected in the country. So anyway, that was just a point of view. They've not heard from any of the regulators. The other big talking point, obviously, was HDB and the fact that they have filed draft prospectus, and RBI has put a rule out there that they don't want any overlap between the banking, what the bank does, and what the NBFC does. And he said that at the moment, HDB lends to people whom we don't lend at all because they lend at very high rates, so probably riskier loans. But they are aware, of course, that Reserve Bank wants there a distinction over there. If the bank, they are anyway going to pare down their stake in HDB. If the regulator feels that there should be more disjunct between the two, then they will pare their stake faster. But they are still waiting to hear from RBI. In any case, it's a financial investment, so there isn't any commonality between them otherwise, is what they said. On unsecured loans, HDFC Bank kind of made us sit up after the Q2 numbers. They were the only people who grew their unsecured loan. Everybody else was bringing it down. HDFC Bank said that they could smell the problem in unsecured loans ahead of the crowd, ahead of the pack, which they've always done. And so they went slow on it before the trouble began. And now that no one wants it, banks are running away from it, they're getting very good credits at, high yields, mouth-watering opportunities. And so now they feel that they can get on to this. as you know, if anything, their slippages slipped, their slippages fell. And finally, the synergies with HDFC, where has it come to? He said that all new loans, 95% of the new home loans that HDFC Bank is giving, they're getting a savings bank account. And of the old ones, they had some 3 million home loans, the old HDFC. Of that, less than 1 million had accounts with them. Now 1.7 million have, and that's the new way of garnering. And the big other synergy is they have sold credit cards and consumer durable loans to these guys because they're sitting ducks. You already done their KYC. Just one click and they get a credit card because all the KYC is there. And there was just a little bit more of discussion on urban demand is not good in retail. It's very good in SUVs, not so good in small cars. Very good in luxury homes, not so good in mass housing. So that problem with urban consumption is there. That was the other thing.
Latha, thank you very much for that. That's a very exhaustive kind of, business segment by segment kind of takeaway with that chat with the top management at HDFC Bank. We'll continue to sort of, focus on, drill down on specific points through the course of the day.